APAC's asset and wealth management industry recently saw further evidence that APAC's next-gen investors are more likely to change their wealth managers. Singapore's private banks look to recruit their up-and-coming high-net-worth individual clients. Hong Kong passed legislation to establish a stablecoin regulatory regime and framework, and China start to aggressively tax overseas investments. Let's take a deeper look at these, as well as other headlines and developments. Up to Hong Kong. Hong Kong lawmakers passed a bill that established a regulatory framework and regime for stablecoins, clearing the path for issuers to obtain licenses to sell the digital assets to the public when the law comes into effect later in 2025. The chief executive of the HKMA, Hong Kong's de facto central bank and financial regulator, stated that a robust and fit-for-purpose regulatory environment would help support the healthy, responsible, and sustainable development of a stablecoin and digital asset ecosystem in Hong Kong. The HKMA also noted that it would conduct additional consultations pertaining to matters such as reserve requirements, client asset segregation, risk management, disclosures, and other areas. The law was seen as further cementing Hong Kong's role as an international financial center and digital asset hub, building on the 10 virtual exchange licenses granted by the SFC, Hong Kong Securities and Futures Regulator, over the last few years. Despite this push, some in the industry are questioning whether the SAR's exchange licenses are worth obtaining, given the capital required and compliance-heavy focus. Some of the industry believe that the compliance costs, reportedly tens of millions of Hong Kong dollars, are too exorbitant, and none of the license holders are able to service mainland Chinese clients, with mainland China seen by some as the primary reason for obtaining such a license. Accordingly, while Hong Kong has built an impressive and comprehensive digital asset framework, the potential of such efforts may depend largely on decisions made by Beijing. Moving on. The Deputy Chairman of the Liaison Office in Hong Kong, the Representative Office of the State Council of the People's Republic of China in the SAR, recently called for the territory to explore researching and developing a capital market white paper which could solicit input from all stakeholders, including global institutions, in order to elevate the territory's capital markets above those like New York and London. The call comes as deficiencies in certain areas of Hong Kong's financial system were noted, especially around market regulation, transaction costs, and corporate governance. It was noted that while there were positive signs, like the IPO market performing fairly well over 2024, raising a reported 83 billion Hong Kong dollars across at least 66 listings, and returning to the top 5 global IPO venues, there was room for improvement. Beijing appears to be taking a much more active interest in Hong Kong's role as a global financial center, with the governor of the PBOC, China's central bank, noting in a speech that the Greater Bay Area Wealth Management Connect and QDII schemes would be improved on to boost the SAR as a financial hub, though no specific details were provided. The statement also noted that the changes would be part of China's broader plan to drive more capital inflows into Hong Kong from mainland and foreign investors alike. Further, China would help sectors like private equity, venture capital, hedge funds, private banks, and family offices in the SAR, and increase the proportion of Hong Kong-based assets in China's circa $3.2 trillion foreign exchange reserves. Hong Kong would also be strengthened as an offshore RMB center, with plans for cross-border bond repurchases to be enacted as part of the Bond Connect scheme, along with support for Hong Kong to launch offshore renminbi treasury bond futures. Beijing will also permit more mainland financial institutions to trade bonds in the territory, something currently limited to banks, though again, no specific deadline was given for this. The statements follow meetings held in Beijing in late December 2024 between SFC, Hong Kong Securities and Futures Regulator, the People's Bank of China, and the State Administration of Foreign Exchange, a Chinese administrative agency and foreign exchange reserve manager, so maybe a result of those, among other efforts. Up next, a recently signed Memorandum of Understanding between Hong Kong's SFC and the Central Bank of Ireland to create a more streamlined process for fund managers to distribute eligible funds in each other's jurisdictions is not expected to bring many new products to investors, according to industry observers. Under the agreement, Qualifying Irish UCITS products will be authorised for sale in Hong Kong under an expedited 15 business day approval process, and for the first time, Hong Kong domiciled funds will be available in Ireland. It was noted that while the initiative was aligned with the SAR's policy goals of increasing connectivity and promoting Hong Kong domiciled funds to more markets, it was thought that participation could be limited. Precedent appears to point to that, with Hong Kong entering into MRF agreements with Switzerland, France, the UK, Luxembourg, the Netherlands, and Thailand between 2016 to 2021, in addition to the Hong Kong-China Mutual Recognition of Funds program, which arguably stands as the only successful such program. 4 Luxembourg domiciled funds have been registered via that MRF since its inception, for example, and Luxembourg and Ireland domiciled UCITS products comprised circa 2/3 of all SFC authorised funds available for sale in Hong Kong at the end of 2024. Others noted that the move was a positive first step, but that more needed to be done in order to solve the commercial realities, and that there was a whole host of non-regulatory issues like tax, which fund managers needed to address in order for the initiative to meet its potential. It was noted that for local FMCs which lacked UCITS products, the MRF agreement could assist in putting Hong Kong fund structures into the international arena. Whether the scheme sees Irish eyes smiling on Hong Kong or vice versa will be watched with interest. So that is this episode's section on Hong Kong. Check out the links in our profile for this episode's other sections, and do comment if there was something that you think should have been included which was missed. Many thanks for watching. Hope to see you next time.